Good afternoon, everybody, and welcome to this. I'm just going to start with a lot of people, and a lot of the questions we had submitted were about pensions. Great, my favourite topic, of course, as that is my specialist subject. But we will be touching on a lot of other things when we're talking about retirement. So Simon's going to talk later on about the sort of different ways to fund for retirement. So let's just have a quick look at the agenda. So we're going to start with the need for a plan. So what to think about on all those different things. We're going to do pension planning, so that's my bit. And then we're going to go planning with other income, and we're going to pass you over at that point to Simon, and he's going to talk through that towards the end of the webinar. Hopefully this will all be within the hour, and you'll be able to get back to the rest of your day and the rest of your planning. So the need for a plan, I think it's safe to say that that's what we would say. We do truly believe that there is a need for a plan, but there's a lot of things going on in everyone's lives. And so just thinking about where you are now, thinking about the future, thinking about what you want to pass on to future generations. And that isn't just about financial planning. It's not all about money. It's about all bigger things, family, changes in your lifestyle, and all of those things you need to consider when we're starting planning. It's really important to think about these things well in advance, because it's very difficult to do something about something at the time. It's much easier when you think about something a good few years, 10, 15, 20, as many as possible years in advance, to be able to get to the point that you want to get to. And there's lots of different things to consider when you're preparing for your future and preparing for retirement. A lot of people will see in this sort of sandwich generation where you are coming up to retirement, but you're still you're ending up helping your parents and possibly still having children who are dependent, all to do with the cost of living as well. It's quite a difficult time for families to break that dependency between each other. And actually more people are becoming more dependent on each other. So it's, again, something to consider. So these are just a few things that just to get your brain ticking over. So what are you going to want in the future regarding income? Are you going to need large capital expenditure? Do you want to buy a mobile home and go and travel around the countryside? Do you want to just stay at home and work on the garden? All these different things mean that you need different options in retirement, and that might drive where you save, how you save, the different wrappers, and it will drive the conversations with your advisor as well. You need to be upfront about your goals. We do a lot of goals-based planning, so we start with our goal and we work backwards to where we are today and how we can get to that goal. We use other things such as cash flow planning, for example, to work out how that goal can be met, with planning on money coming in, money going out, and taking account of all the taxes as well. So there's lots of things that can be done to try and build this plan, your life plan and your financial plan. But you need to start considering what you want and what you need for us to be able to do that. This is where I want to retire. This is what I want to do. I thought I'd just share a bit of personal. This is where I was on my honeymoon, which was over 11 years ago now. But I like traveling. I haven't had a chance to do a lot of traveling. I didn't travel a lot as a child. So I want to spend a lot of my retirement and my later life traveling and seeing the world and seeing lots of different things. So this is Mexico. I've been there twice. I don't need to go there again, but there's lots of other places in the world. What does that mean about my financial plan? It means I've probably not saved enough if I want to do all the really exciting things that I've got in my head. So I'm, again, just this moment in time, just increasing my pension contributions to make sure that I'm actually saving that bit more so that I can do that bit more when I come to retirement. And I'm also taking into account lots of other things that I'm doing. This is actually a really interesting thing to consider. We do deal with a lot of people where we talk to them a little bit later in life, and you can see that if they started engaging with an advisor, making contributions earlier, that they might be able to have a better retirement or retire earlier, as it is. This is a document that you can actually get from your SJP advisor. It's called Our Cost of Delay, and there's some more graphs and things on there. But it's interesting to show you that if you delay by 5 years, you could see a 23% reduction in the amount of funds you had at retirement. 10 years, 42, 15, 60%. And so getting started, taking that advice, taking that plunge is really, really key to that good retirement. However, that said, it's never too late. There's lots of options regarding funding, and we're going to talk about those in a moment, that mean that you can now fund that bit quicker into the pensions. But pensions aren't everything. Simon will talk about the other options. And those options will give you wider ranges of things to be able to invest in. Use it or lose it. So that's another thing. There's lots of changes that we see over the years. There's lots of allowances that I'll talk about and Simon will talk about. But a lot of them, you need to use them in the tax year. So making use of them year on year is really important. And understanding what they are, we'll touch on them today, but getting advice to understand your circumstances just means that you are not going to waste the allowances that the government gives us, perfectly legitimate ways to avoid paying tax. And they are legitimate, you know, that's what they do these for, encourage you to save. So make sure that you're using all of those as and when it's appropriate for you to actually put that money into those different tax wrappers. So that's a little bit of just scene setting. But I think, you know, we're here to talk about pensions, so let's get on and talk about pensions. The most important thing, and one of the things that I find quite often, is people forget that they've got certain pensions. We often hear about these frozen pensions or lost pensions, and they're not frozen and they're not lost. If they're yours and they're in your name, they should still be there. If you've got old workplace schemes, places you've worked over the years, the likelihood is that you had a pension there. Not all cases, but the likelihood is that you had a pension. And some of those old pensions can really sort of build up quite a lot over the years. I always use my dad as a classic example. He didn't realise that when he ran pubs in London when I was a baby, that Whitbread were actually saving into a pension for him. So he had a very good pension with them. I mean, it wasn't for a very long period of time, but he did have a pension there, which he wasn't aware of. They actually tracked him down when he got to retirement age, which is actually quite impressive, and actually very unusual. Because he'd moved multiple times, he got married, got divorced, done all sorts of things, but he wasn't probably where you would expect to find him. But they did find him. But that's rare. So finding your own pensions, keeping track of them, and most importantly, making sure that those pension schemes know where you are, means that when you come to retirement, then you can actually utilise them. As well as telling your financial advisor, telling your SJP advisor what these are and where they are, so that they can look at them and make sure that they're working for you. We say they're not frozen, but some of them might not be in the most appropriate way that they're invested. Some of them might need to be moved. Some of them may be very, very restrictive and not give all the options available when you come to retirement, or in the worst case scenario, on your death. A lot of them, older schemes, will have significant reductions. So you can speak to your partner who will help you find them, or you can use the find the pension contact details and then just get in contact with them. They'll usually ask name, address, national insurance number, and maybe the address you were at when you worked there, and they'll be able to hopefully track you down, track down a pension, or tell you don't have one with them, and that will get you peace of mind as to know exactly what you've got and where you stand. Most important, as I say, keep that information up to date. If you do find a pension that you didn't know you had, make sure you update their details and make sure you keep them updated if you move again. So let's just look at the pensions basics. This pension, so our pension, the St James's Place retirement account, is what I call a savings pot. So that's one type of pension. So a savings pot, the money goes in, it's invested, and that pot is there to provide you with income in retirement. There's another type of pension that we'll see, which is called a defined benefit pension. And I think about that generally as a promise. And that's a promise your employer made to you when you were in part of that scheme to provide you an income in retirement. For those people, I know we've got some people who work for the NHS on the call because they asked me some questions. So that, such as the NHS, that's a defined benefit pension. Teachers, any of the public sector schemes are that type of pension. But there are private sector ones out there as well that provide you with that promise. The majority of things I'm going to talk about today are regarding the savings pot. I will touch on the other ones, but what we see when we're saving into the pensions with St James's Place are the savings pot options. So in essence, it's a tax efficient savings plan. They both are. So you put money in and it builds up in a tax efficient way. We'll talk about the tax relief you get in a moment. There are restrictions because of the tax relief you get, and those restrictions are the age at which you can access it. So they can only be accessed currently from age 55, but that's going up to 57 in 2028. And there will be other restrictions if they're workplace schemes. So some companies will say you can only access your benefits when you leave us, so when you retire. Some companies will say you can only access benefits at age 60 or 65, or even state pension age for some of the public sector schemes now. Often you can access those ones, so the defined benefit ones, access those ones early at a reduction. Obviously, the sooner you take your money, the less you'll have saved. So again, thinking about when you want to access them will make a big difference. 25% is generally available tax-free. So a quarter of the pot is generally available tax-free. I say generally because there's always a complex rule with a pension. So some schemes may provide a little bit more than that if they're, again, old schemes. Usually schemes that were around before 2006 might provide you with a little bit more than that. And we do have flexible income options in retirement. Again, I'll talk about those income options in a moment. But again, it's important to remember not all schemes are the same. Just because the government says you can do something doesn't mean the scheme will actually do that. So asking questions, finding out, getting an advisor to look at your plans to work out what's actually available is important, because quite often you need to move things around or change the scheme in order to be able to do what suits you in retirement. The tax relief, how does tax relief work? Well, you have to pay tax to get tax relief, mostly. Very low earners can actually still get tax relief, but generally, if you are a 20% taxpayer, you're going to get 20% tax relief. If you're a 40%, 40%, and if you're a 45% tax relief. How does that work in practice? Well, actually, for every £100 going into your pension, generally you'll put in 80. You put £80 in, we as the provider will claim £20 back. And then if you're entitled to the extra 20 or 25, you do that through your tax return or by calling HMRC and telling them what you've done. If you're doing it through a workplace scheme, quite often they will do that for you. So you'll actually pay it before you pay tax. So your money will go into your pension before you pay tax, so you don't need to do anything. So just make sure you understand how your scheme works and whether or not you need to do anything. If you haven't remembered to claim that tax back and you are due it, then you've got 4 years from the date at which the tax year in which you paid it in to be able to go back and reclaim that. So get in contact with HMRC and make sure that you're getting that tax back legitimately. But they give you 4 years grace on that to be able to reclaim. So make sure we're doing it. We see it every year with people discovering that they haven't actually been claiming it back, or they didn't realise they were going over into another tax band and they were entitled to do that. Pay rises, bring with them changes to things we have to do. Tax relief is one thing. We also have allowances that the government have put in place. So people don't put all their savings, all their money into a pension, because as I say, it's a very tax efficient way to save. So it's the annual allowance has been set at 40,000 for a significant amount of time. The budget in March changed that and said, we're going to increase it by another third. We're going to give you 60,000 that you can put in. That it feels high, it sounds high. It's actually a really decent figure for most people to be able to save. Although when you're talking about some different types of scheme, you can use those allowances very, very quickly. We have seen other changes when over the years for them to try and restrict the annual allowance for those people earning over significant amounts. So it's changed over the years. So it used to be, well, if I earn over 110,000, I was deemed a high earner. Now it's if I earn over 200,000, I'm deemed a high earner. And therefore, what you see is a reduction in the amount that you can save into your pension. So you start at the 60,000 and that reduces down to 10,000. So I'm going to apologise at this point. I've noticed the typo on my slide. It tapered, should say 10 to 60. What we see is for very complicated calculations, so everything you earn, so not just money that you earn through salary, money that you earn through even pensions, property, dividends, interest on savings, all of those added together. And they use that to look at whether or not you're deemed a high earner in this sense, and whether or not the amount you can save into your pension starts dropping down. We also have what we call the money purchase annual allowance. So when you started to take money from a pension, the savings pot variety, and you take an income out of there, then the amount that you can save back into a pension is reduced to 10,000, and that's a flat rate. So flat rate of 10,000 going forward. If you've still got one of those promise schemes, so the defined benefit schemes, then you can actually continue to save into those using the full annual allowance that you'd be entitled to, subject to taper. Obviously, there's always an if and a but and a maybe with a pension conversation. The nice thing about the standard annual allowance and the tapered annual allowance is if you don't use it, it's not a use it or lose it. It is a use it or use the previous 3 years or lose it. So we can go back and use some older allowances if we need to, if they're available. But again, there are restrictions on the amount of tax relief you can get depending on what you're earning. So as I say, it's a complicated area, and just being mindful of not going over. So what's the question? What happens if I put in more than the annual allowance? Well, basically, the government takes back the tax relief that you would have got. So it takes the amount that you go over your annual allowance, sticks it on top of your earnings, and tax it accordingly. So the likelihood, if you've gone over that, you're probably going to be a 45% taxpayer. So you'd get a 45% tax charge on that bit over and above. There are options, don't panic if that's happened to you. There are options to pay that through schemes and to pay that in different ways. So just have that conversation, don't hide from it, and have that conversation and get that addressed at the point of you doing a tax return. So have a conversation with your accountant and with your advisor, and they'll be able to tell you what your options are. At this point, I'd usually go onto a slide that says the lifetime allowance. But you've probably seen in the press that the government decided at the last budget they were going to scrap the lifetime allowance. We're going to get rid of it. We're not going to need it anymore. It's not entirely true, I must say. What they've done so far is what they've taken away is the charges. So if you go over the lifetime allowance, which is currently 1.0731 million, nice easy number to remember, then if you've got money in excess of that in your pension and you were to start taking it, or hit 75, so there's no escaping it, unfortunately, then you would get a tax charge, and that was in essence 25% and income tax, or 55% if you took it all out as a lump sum. What they've done is they've got rid of that 25% charge. So if you're over and above it and you take it out as income, you'll just pay income tax. If you're over and above it and you draw it out as a lump sum, you're just going to pay income tax. So they haven't actually got rid of that 55 charge. They just changed it to income tax. But what that does is gives us options to consider if we've saved into a pension and we thought, well, we'll stop now because I'm at the lifetime allowance. A lot of people have had those conversations with their advisors. They might have different lifetime allowances. I know someone has asked in the questions regarding protections. So people have had over the years different lifetime allowances where it's changed. We had 1.8 million, 1.5 million, 1.25 million, 1 million, and then it went back up to the 1.0731 million. And if you want to put in more now, then you generally can. And I say generally because you need to be mindful about the fact that actually, what am I getting for doing it? Is it the right thing for me? Have I got other options? Look back to Simon and what he's going to talk about as well. So having those conversations about what's right to do, even considering the lifetime allowance. I think just this point, I'm just going to touch very quickly on what happens if they reinstate those charges or reinstate the lifetime allowance when they finally get rid of it. I know people have asked me, Labour has actually said that they want to put it back in place if and when they get into power, and they want to get rid of this free-for-all, I think, as they saw it, on pension savings and put it back in. What does that mean? Well, we don't know, but what we've seen in the past when things have been brought in, so the lifetime allowance didn't exist until 2006. When that was brought in, we got to protect what we'd saved at that point. When the lifetime allowance dropped in 2012 and 2014 and 2016, we got to protect what we'd saved under those regimes. So we hope and we expect, based on precedent, that we will be given some protections if the lifetime allowance is brought back in or something else. You know, they might invent something entirely new with another name that I then have to remember. So that's what we're expecting to see. So all we can do at this point in time is invest in our pensions using the current legislation, allowances, and just be mindful of the fact that things do change and have changed over the years. I've been in this industry for 23 years, and I don't know how many regimes I've seen, but I can still expect there to be many more before I actually get to access my pension a good few years down the line. Just again want to think about making pension contributions and the fact that actually making pension contributions has other benefits. So a lot of things in the world of tax revolve around a figure called the adjusted net income. So that is, in essence, everything you earn, you take off your pension contributions and you take off gifts to charity, for example. So you can reduce that down by putting money into a pension or giving money to charity. And that figure is often used for different tests. So it's used for the child benefit test, so the high income child benefit charge. So anyone who's claiming child benefit and has earnings over 60,000 either doesn't take the money or will pay a tax charge on the money that they receive. So you can opt to claim your child benefit and tick the box to say, don't send me the money. But say you were earning £60,000 exactly. So it has to be one person in the household earning this figure. So either or, it's not unfortunately an aggregate. Then if they were to make an £8,000 pension contribution, they'd get £2,000 worth of tax relief, which would reduce their adjusted net income down to 50,000, and then they wouldn't have that issue to worry about. So you can see that by making pension contributions, there are knock-on effects for things like that. So it's worth considering, are there benefits that you may get by making those extra contributions, not just the tax relief, not just the saving for retirement. It's a kind of win-win. We have another band when we look at tax rates. So we have our basic rate, where we have our personal allowance, which is up to the 12,570. Then we have our basic rate band, then we have our higher rate band, and then we go into additional rate. But there's this band in the middle of all of that that isn't really a tax band. But when you earn over 100,000, what you see is the reduction of that personal allowance, that 12,570. And that reduces down pound for £2. Every pound of earning, or every £2 of earning, you get over the 100,000. Effectively, that is a rate of tax of 60% because you're paying 40% on it and you're losing the tax-free amount, which pushes that into a 20% band. So pension contributions reduce that. So if you earn 125,140, and you put in 25,140 including tax relief, then in essence you're getting, well, the 20% tax relief, in essence you're getting 60% tax saving on that. So have a conversation if you're in that band, or even if you're earning up to 160,000 and you have the capability to make pension contributions of the 60,000, then that will actually bring you all the way out of that. You'll get 45% tax relief on the bit above the 125,140 and 60% on the next 25,140. So there's the real benefits depending on where you sit in the tax regime to making those contributions. So let's get into, how do I get my money out? Everyone's always interested in how they get their money out. So these are the two main options that we see for the savings pot. But before we get into that, let's just talk about those defined benefits, those promise schemes. So for those, generally what you'll have is someone will have said, at retirement, you've worked for so many years, you've earned so much money, so we're going to give you this income, and whatever that income is. That income, part of that could be exchanged for a tax-free lump sum. So you'll see in here, we talk about tax-free lump sum of 25%, calculated slightly differently in those types of schemes, but you'll generally be able to get 25% of the capital value, as how we look at it, out. So you can give up a bit of income and take some tax-free. Generally, that works quite well for people, mainly because it's tax-free and you've got it up front, so you can do something with it, pay off your mortgage, go on holiday, world cruise, whatever it is you want to do, buy a caravan, lots of different options. And then you get that income, and that income for life generally. That income generally also increases. It'll increase by different amounts depending on different schemes, but they're nearly always attached to inflation one way or another. So it might be inflation up to 5%, it might be inflation entirely, it might vary depending on different bits, as in when they were earned. So there's lots of different things that go on there. But generally what you're doing is you're getting an income, and that income will be paid for the rest of your life and there'll be options for half of that generally to go to your spouse or civil partner when you die, and they will continue it for the rest of their life. If you've got very young children, there's often options there for them to receive something too. But look at the type of scheme that we provide. Our savings pot, generally you've got this option to draw money directly from the fund. So that's what we're calling drawdown here. It's called Flexi Access Drawdown now, because it's very flexible. You can take as much or as little as you like income in any 1 year. How much should I take? I think we got that question in. How much is it safe for me to take out? Well, it really does depend on how you're investing it, how you want to live your life. How long do I think I'm going to live? You know, there are many, many moving parts here. So there's never a one size fits all drawdown option. Some people will draw lots early on and then live off other assets. Simon will talk about what's more likely. You'll live off other assets and you'll start drawing your pension later. But drawdown is not guaranteed, and that's the important point here. Drawdown remains invested and you're drawing it out from the investment pot. So as things change in the markets and they fluctuate up and down, how much you draw might change. So again, ongoing advice, having good conversations, changing what you draw out at any point can really make your money last a lot longer, and utilising things like the tax-free cash. It's possible to take that tax-free cash with us monthly, for example. You say a bit of tax-free cash, a bit of income. Well, what does that mean? Generally means overall in the year, you'll pay less tax. Can't do that forever because your tax-free cash will run out, but you can actually mitigate some tax as you go through by using that tax-free lump sum, not as a lump sum, but as another way to provide income. Very, very efficient way to top up your income every year if you don't need a lump sum on day one for anything in particular. You've always got that option to take the rest of that lump sum that you haven't used at a later date, provided you haven't sort of accessed everything, but you can use it as you go along. The other option is an annuity. We don't see these as often, but actually it's something to consider, because you can buy an income for life. So again, this one, you have to take your tax-free cash up front, so that 25%, if you want it. You don't have to take it, but if you want it, take that. And the residual of the pot, so you take all those investments, you cash them in, give them to an insurance company, and they will promise to pay you an income, very similar to those promised income we talked about earlier, for the rest of your life. And you can have lots of different options there, regarding whether I want to have something passed on to the next generation, or whether or not I want to protect it for a certain amount of time. So you can get something like a guarantee period, which means it will be paid for at least 5 or 10 years if you don't survive that long. So there's options there to protect yourself. So they're the two sort of main options. As I say, all those extra bits on that annuity side of things, the more add-ons you have, the more protections that you have, the more costly it will be. So the lower your income will be. And they're not an either or. So we often see people who buy an annuity to protect themselves as their base level. What's my base income? Maybe I've still got rent. I've definitely still got council tax, all of those sort of things. How much do I need to know that I'm going to be able to be perfectly happy in my retirement? And then the rest of it could remain invested and taken in a different way. So having those conversations, getting the right balance of the way that you access your income can make a big difference in the future to how you work your life, and how these things change. Drawdown, say, flexible but more risky. Annuity, less flexible but quite costly. So different options there, and dependent on your circumstances, your health, your attitude to risk, and all of those things will determine what's right for you. There's no way I can definitively say that going at this point, what would be right. So I'm going to stop there. I'm going to pass over to Simon. I'll have a read of the questions that I know a few of you have sent in, and we'll come back to those at the end. So I'll pass you over to Simon and go all quiet for a moment, which isn't in my nature.
Thank you, Claire, and good afternoon, everyone. And so Claire's just given us a really, really comprehensive overview of both pre and post retirement and how pensions can be used as a fantastically tax efficient tool for both funding your income in retirement, but also accumulating a pot for the future. The next stage then is to take that a little bit further, because as you were considering this session, and I'm sure, well, certainly based on the questions that we had, would back this up, when people think about retirement, they naturally think about pensions because the two go very much hand in hand. However, the simple days of retirement planning and pension income, largely for most people, are gone now. The days where you used to hit retirement, your company or your state pension would kick in, and then you'd move from one stage seamlessly to the other, have moved on. And things have become a bit more complex. There's lots of other options, lots of things to think about. So I'm going to spend a little bit of time looking at what other options could you have in retirement? So what else could you do to create that retirement income? Claire talked about pensions being a very tax efficient way of holding money. And we're going to take that concept a little bit further. We're going to look at, because pensions are so efficient, does it make sense to draw income from other places? The answer to that often is yes. We're going to explore that a little bit. And we're going to look at how the creation of your retirement income fits in with estate planning, i.e. how, where and what you pass on to the next generation, and how can you make sure those assets are safe, protected, and we've legitimately reduced the taxation on those assets as much as possible. So we're going to cover quite a few different bits in the next 25 minutes or so. What's hugely, hugely important is to remember exactly as Claire said, that every plan is individual. So I'm going to talk about lots of things today, some of which will be very relevant to your circumstances. Some will be not relevant at all, and that's absolutely fine. But it's really, really important to sit down with your St. James's Place partner or advisor to think about, how do I get to where I want to get to? How do I create an income in retirement? And what do I need to do to make it all fit together nicely? So there's three things to think about, or three main things we're going to look at today. Number one, or when you're thinking about drawing down and creating retirement income, number one is investment risk. Being really careful and clever about where you invest is really, really important. And also making sure you draw money from places that have done well, because that means you're going to reduce something called sequencing risk, which is the negative impact of drawing funds from assets which have dropped in value. We're going to consider the taxation of the assets you're drawing from. Some assets, such as pensions, very, very tax efficient. Therefore, trying to preserve your holdings there is often a prudent move. And also the taxation on income. You don't need me to tell you that it's much better to draw a tax-free income than it is a taxable income. If nothing else, it means you have to draw less to create the same net income. Therefore, you leave more in your pot and it lasts longer. Obvious stuff, I know, but building that in practice can be tricky, and it's where advice is really, really important. And it's particularly important when you get to retirement, when you move into the stage that we call decumulation, because your human capital, or to say that another way, your ability to build up further funds is perhaps stopped or certainly diminished. Therefore, being really careful about what you do is even more important, because your capacity to rebuild is lessened. So taking advice and building a careful strategy is really, really important. So where does that leave us? Where that leaves us is to take a very holistic approach to the creation of your income in retirement. And as I said, historically, it would have been lovely and straightforward. I retire at 65, my company pension or my NHS pension kicks in if I work for the NHS, and my state pension kicks in, and that's my retirement for the future. Nice and simple. Well, now things have got a bit more complicated. So we take what we call an all asset approach, which is, let's look at all of the assets that you hold as an individual or as a couple or as a family, and how can we draw the income that you need from those assets in the most efficient way? Now, historically, pensions would have been the first place. And if I said to you, how are you going to create retirement income? 99% of people would say pensions. And in a sense, that's true. It's not untrue. But actually, pensions over the last few years have gone through some serious changes, particularly in 2015 in what was known as pension freedoms. I won't bore you with all the details, but essentially what it means is the pensions can now be passed to broadly whomever you wish, whilst retaining the pension wrapper. So if I, as I do, have a pension, I die, I could, even if it's pre-retirement, I could pass that pension pot, because I have a pension pot, not a promise, as Claire talked about. I could pass that pension pot to my wife in the form of a pension. She then dies. She could split it between our children. In years to come, when they have children and they die, they can pass it to their children. So a pension has become an incredibly tax efficient and intergenerational family trust fund that is not subject to inheritance tax on death. There's little to no tax within the fund, and you've got full access to it. When you start to weigh up all those things, you realize actually a pension is a very, very efficient way to pass on my assets that I built up to the next generation. Now, of course, I'm talking slightly idealistically because many people have just their pension and that's what they need for retirement. And absolutely, if that's what you've got, then that's what you use. But the question is always, do you have other assets that could be used for your retirement? You know, second properties, investments, businesses, cash holdings. Do you have other assets that could be used to create that income, even if it's in the short term, to allow your pension, your very, very tax efficient pension, to remain invested for longer, or potentially be a larger sum ultimately when you pass that to the coming generations? So a big part of the advice we give to clients at this point is, let's think really, really carefully about the assets you've got and how those assets can be utilized to create a really, really efficient income in retirement. So, as I said, many people will like to leave, or certainly we see a lot of clients like the concept of, for obvious reasons, leaving inheritance tax-free pensions alone and drawing assets from other drawing income from other assets, and that makes a great deal of sense. You then move on to looking at, well, how can we do it in a very tax efficient way? You know, how can we build my tax efficient life, if you want to call it that? How can I build my journey from accumulation? And Claire talked about that. If you remember the slide that showed, for a higher rate taxpayer to put £100 into your pension pot is going to cost you 60. You know, if you're thinking towards a number that you need in retirement, a retirement fund, clearly if 40% of that value is going to be paid for by tax relief, that's a really, really smart way of building up a great retirement pot. So the accumulation is important. The decumulation, we'll look at that in a bit more detail in a moment. How can I create an income stream for myself in retirement whilst legitimately paying as little tax as I possibly can? It can be done. There's loads of options, and we'll look at that. And then finally, what about the next generation? What does it mean to pass assets to my children, to my grandchildren, to, you know, whoever I wish to do? And how can I do that in a way which is both inheritance tax efficient, really important, we'll look at that, but also controlled and protected? How can I make sure my assets are looked after for the next generation? So, as I said, advice is key because it can be complicated. There's lots and lots to think about. Now, the UK tax system is nothing if not complicated. The number of different allowances, exemptions, reliefs that are available is crazy. And every time there's a budget, you always get the Office of Tax Simplification coming out with the same message: the UK tax system is too complicated. And they're probably right. It is. But within that complexity always creates opportunities. And the structure means that there's lots of different ways that you can create income which is tax-free or taxed at zero. So dividends of up to £1,000 from whichever source, regardless of your tax rate, are tax-free. A couple, that's £2,000, £2,000 of tax-free income. Is it a lot of money? It's not a huge amount of money, but will it make a difference? Absolutely. You can have interest. It's complicated. I won't go through details, but you can have interest and offshore bond gains of up to £6,000 a year for basic rate taxpayers or non-taxpayers, completely tax-free. The application, as there's a lot of things, does need to be looked at carefully, but potentially there's tax-free interest of up to £6,000 a year. And we can also have the first £6,000 of capital gains, that is gains through the sale of shares or property, etc., taxed at zero as well. So actually, when you start to accumulate all of those allowances, we can start to think about, do you know what? There's a lot of income that can be created that's going to be without tax, really, really attractive. A lot of income that can be created to say, well, actually, if I'm paying 0% tax, I need to draw 20 or 40% less from my portfolio. It's going to last a lot longer. So careful creation of income is really, really important. And your SJP partner or advisor can absolutely help you with that. The conversation is broader because there's lots of other allowances as well. So we've talked about the dividends, the savings allowances, but everyone who has income of under £100,000 has a personal allowance of just over £12,500. That's tax-free and can be set against any income. Really, really important to make sure that however you're creating your income, you're utilising all of those allowances. And above that, there's lots of other things. You may have ISA holdings. ISA holdings are fantastic because the income tax and capital gains are tax-free. So what a great way to create an income. If you've built up an ISA portfolio, it's very often a great way to create an income, particularly if it allows you to leave your pension alone for the entirety of your retirement or even for a while. For the higher risk investors, venture capital trust dividends are tax-free, and investment bonds. Some of you may hold investment bonds, and you can draw up to 5% per annum of the original investment back tax-free, or tax-deferred rather, and that can be used to create an income stream. So there's lots of options. Just about every asset you hold probably has some means of creating a great income for you, and doing it in an efficient way is really, really important. So building your income is vital, but we also need to think about inheritance tax, because inheritance tax is one of those taxes which is somewhat stale. People don't really think about it too much, or they think this doesn't apply to people like me, this is only for the really, really wealthy. But actually the inheritance tax squeeze we've seen has been fairly significant. The main rate of what's called nil rate band, which is the amount of assets you can pass in lifetime and on death without tax, has been frozen at 325,000 since April 2009. And under current legislation, it's due to be frozen until April 2028. We've got 19 years of that not moving. If you think about normal price or asset growth increases, property, shares, etc., over that period, what we're going to see is a lot of people pulled into inheritance tax. So you've got 325,000 that you can use, and then you've also got potentially another 175,000 to offset against your main residence. And everything above that, once you've exceeded your exemptions, charged at 40%. It's a significant tax if you get caught with it. So thinking about how you balance those taxes is really, really important. What you don't want to do for most people is spend money, which is inheritance tax free, such as a pension, and leave money to grow, which is inheritance tax chargeable, such as investments, ISAs, etc., etc. So considering inheritance tax as part of your drawdown or decumulation strategy is really, really important, and a big part of what your partner or advisor can talk to you about. So inheritance tax, as I said, just to give you an example, there's a couple of examples you'll see on the screen. If you look at the example for the third person who's got an estate of 2.7 million, you'll note that their residence nil rate band is 0. The reason for that is once you've got assets over 2 million, your residence nil rate band starts to abate at a rate of £1 for every £2 you exceed 2.7 million. So over 2 million. So when you reach 2.7 million, your 350 band is down to nil, and you'll start to see some really significant tax increases. Therefore, careful planning is really, really important. What we want to make sure when working with you is that your assets are protected, controlled, and we think carefully about what you'd like to pass on, what your current liability might be, and what, if anything, we can do to mitigate the impact of tax on your estate. That's really, really important, because certainly many clients that we talk to say to us, I want to pass on as much of my hard-earned wealth to my family as I possibly can, and that's perfectly normal. And what else do we need to think about? So tax will potentially reduce the value of your estate, and that's something that we need to be really, really careful about. But what else? We also need to think about how well will the generations to come look after assets that you've spent a lot of time and a lot of effort building up. there's an expression in Cornwall, which is the third generation always walks to church, essentially saying the first generation builds up the wealth, the second generation has seen the wealth being built up and have some respect for how that's been done. The third generation is a little bit removed and often blows it. That's why, we see that cycle often. So the question we get from a lot of our clients and the conversations we have with them is, how can I make sure that my assets are protected so that if the next generation aren't, or subsequent generations aren't as careful as I am, how can I look after them? And very often we use trusts. Trusts are a really, really simple way to hold your assets. You can put them in assets into trust on lifetime or on death. And it's a way of saying, essentially, you're splitting the legal and the beneficial ownership. You're saying person A is looking after the money because I trust them, they're a trustee, for the benefit of person B. So if person B needs the money for a genuine, legitimate reason, I want to go and study, I want to buy a house, I want to do something that you will approve of, no problem, they can release funds for them. If they decide, actually, I don't think you're quite responsible enough to have that money yet, they can say no. So it's a really careful, considered way of protecting your assets, protecting what you've worked so hard to build up. And much of our planning does involve trusts. We do a lot of work in the trust arena because we believe that protecting money from taxation, of course, but also making sure it's used for the purposes that you want is vitally important. So how can we build that all together? What's that got to do with retirement income? Well, I just want to conclude over the next couple of minutes by talking about or demonstrating a couple of tools that we use that can tick all of the boxes that we've talked about. They can create an income in retirement. They can utilize a trust to provide control and protection. And they can allow you to leave your really, really inheritance tax efficient assets and also save inheritance tax on what we're doing. So the first one is called a loan plan. A loan plan is a structure whereby you create a trust and you loan the trust or the trustees an amount of money. That amount of money is invested within the trust and it grows with the growth outside of your estate held on trust for the next generation. So let's use an example. I loan £100,000 to my loan trust and that money is invested and it's growing. All of the growth is not owned by me. It's owned by the next generation who will hold it through a trust. That's great. What it does, it means that growth, which would otherwise belong to me and be subject to tax, is no longer. But what it also gives you is the ability to draw back that loan over time as income. It's not actually income, it's the technicalities mean it's actually capital, but for the purpose of the illustration, we'll call it income for simplicity. And let's say you draw back 4% of your loan every year. I've put £100,000 in and I've drawn back an income of £4,000 a year. What that's doing in practice is reducing the outstanding loan that's owed to me. So over time, I'm reducing the outstanding loan. The outstanding loan is an asset because it's the debt that's owed to me. And over time, that reduces to nil, at which point there's no value in my inheritance tax estate. So over 20, 25 years, maybe long-term planning, it allows you to garner my inheritance tax advantage, create an income, and all of the growth is held in trust. So it gives you control and protection over the next generation. A really, really nice way of saving tax, creating an income, and protecting the next generation. The next option is similar, but it's for those people who are willing to make a gift. So you can make a gift into something called a discounted gift plan, which you make a gift into your estate. So this is typically for clients who look at their assets, who do a review with their advisor and say, if I were to die tomorrow, or if we were to die tomorrow, some of my assets would be subject to inheritance tax, and I don't want that. If you make a gift, typical gifting rules mean that you make a gift and you live 7 years, the gift will be outside of your estate for inheritance tax purposes. So how can we utilize that for great planning in retirement? Well, this person makes a gift into the discounted gift plan. It's a gift for the purpose of inheritance tax. Some of it is immediately free of inheritance tax, typically. and the rest is free after 7 years. But what it allows you to also do is to fix an income stream from the outset. So you've gifted money in, that income is going to pay to you for your lifetime. And then after 7 years, the value is outside of your estate. And on your death, the assets are then held on trust for the next generation. So that gives you two key advantages, or three rather, as before. Number one, after 7 years, you've got a fantastic inheritance tax reduction. You've got an income stream for life, and you've held that money in trust. So regardless of the next generation's, regardless of how you see the next generation, or even if you're worried that what happens if there's a divorce or a bankruptcy or if someone goes rogue, whatever might happen, it's protected in trust. So you've got the security and peace of mind of knowing you've got the trust, you've got the income, and you've got some inheritance tax advantage. And it fits within that overarching principle which we talked about earlier, which was leaving your pension alone and where possible, and finding other clever ways to create income. So will these be for everyone? No, they wouldn't, absolutely. But if you're looking for income in retirement and you're concerned about, or you'd like to keep your inheritance tax as low as possible, and you want to make sure the next generation are looked after, it could well be for you. So please do get in touch with your St. James's Place partner or advisor. So we've covered a lot in the session today. Claire started off by looking at the need for a plan, why it's so important to have a financial plan, why it's so important to know where you want to get to, and putting some numbers around that. So I want this amount in retirement, this is what I want to look like, and how can I build a plan to do that? Claire then looked at pension plannings in terms of accumulation and decumulation, and then we concluded by looking at planning with other income. What else can you do in retirement to create an income? So all that leaves me to say before I pass back to Claire, I think for some questions, is thank you again for listening. I hope there was something that you could take away. And Claire, over to you for any questions.
Excellent. Well, we've got a couple of questions for you. I've tried to answer the pensions ones while you were chatting. So a couple of questions to put you on the spot here. I'm going to start with the one that's just come in because it was the most recent. Can I put a property into a discounted gift plan?
Short answer is no. No. So
that's a quick one.
It's a quick answer. Planning with property is very, very difficult. We could spend half an hour talking about property planning and trusts. Key things to be aware of my property. If you gift a property into trust, it's generally a capital gains tax disposal. So there can be capital gains tax consequences. If you want it to be efficient for inheritance tax, you're not able to access it. So live in the property or take any rent from the property. And also with a property, if you are renting out, there can be onerous rates of tax on that income. So being really careful with rental properties is key.
Excellent. So
there is planning, but don't. There's planning that can be done. So don't give up the ghost on that one.
Don't just ignore it. Next one, is the income, which is actually capital, taxable income to the person who, in your example, draws 4% income from their loan trust?
Yeah, it's a really, really good question. The taxation is complicated, but they call it tax deferred income, which means there's no immediate tax as long as you draw. You have a 5% allowance. It's a little complicated because part of the allowance is used up by certain fees, but we say 4%. So if you say 4%, broadly, that will be comfortably within your 5%. That's not immediately taxable on you. In years to come, if that investment is, or when that investment is sold, all of that income is counted back in to work out how much true profit has been made. So there will be eventually a tax reckoning. But for the purposes of particularly key, the adjusted net income that Claire talked about, it wouldn't form part of your adjusted net income. You wouldn't need to do a tax return as long as it doesn't go above your allowances.
You just prove again it's very complex. We've had a question in about nursing home and elderly care fees, which I'll just pick up on, and then Simon, you'll probably be able to add something regarding some other bits. But what you can do with elderly care fees and nursing home costs, there's a couple of options. There's an immediate needs annuity, which you'd use capital to buy for, and it's like buying an annuity, as I talked about. There's no tax-free cash, but you buy this annuity and the income is then paid directly to the care provider, and it would be tax-free. So that's brilliant. There's a deferred option of that. So say I buy it now thinking I'm going to end up in a care home in the next 5 years, and the income starts in 5 years' time, or whatever the deferral period is. So there are things that you can do at the time or near the time that you're going to need that. Alternatively, it's using your other assets to actually fund those, and some of these things that Simon's talked about would be able to fund care in the future. So I think again it's planning that, having that conversation, thinking about your family, what's happened in your family in the past. My family seem to live forever. It's a great thing, but it ends up costing a lot of money. So I know that I'm going to need to fund to at least 90 based on my mother and my grandma. I think the one thing I'm going to be factoring into my life is longevity and the possible need for a care home as well. So Simon, do you anything you want to add on that?
No, only to say there are certain trusts that you can gift into, as you kind of alluded to, that allow you to create an income if care is required. So again, it's careful. I think I just echo careful planning is really important, and early planning is really important, because if you're going into care next week, it's pretty challenging. If you're thinking in 20 years' time I may, there's a huge amount more that you can do.
Yeah. One last question, which is one of our early ones. So on inheritance tax, so IHT, I understand that tax has to be paid in full by your beneficiary before probate can be granted, which is when they would access the funds. This could run into hundreds of thousands. Where does the beneficiary get those type of funds from typically?
Yeah, it's a great question, and one which has been a problem for certainly the 20-ish years that I've been in the industry. HMRC won't give you the money until you've paid the IHT, or you can't get probate until you paid the IHT, and you can't pay probate until you've got the money, because that's what it's based on, and it's an age-old problem. Certain assets will allow you to take money from them. Certain bank accounts, certain national savings will allow you to use that money. If the estate is made up of certain assets, largely property, they will sometimes allow you to pay it over a period of years, so sometimes 10. Obviously, interest is charged. Assets in trust don't go through probate. So if you've got assets in trust, you can use that to pay the inheritance tax bill. The St James's Place trust range, pensions, absolutely. St James's Place trust range allow you to loan. So the trust can make a loan to a beneficiary who can pay the inheritance tax and then repay the loan. So it means you're not having to extract all of the money from the lovely protection that comes with it, with a trust. And then the final way that a lot of people end up doing is very short-term borrowing. So certain banks will do effectively probate loans to say, look, you're going to borrow this for a month, get the bill paid. Once you've got the money back, you can then repay it. So lots of options. But yeah, you're right. Absolutely. It's a challenge that's been there for a number of years.
Insurance is also an option, isn't it, Simon? You could insure against the liability in your lifetime, so that your beneficiaries will have access to those funds, which will be outside of your estate, in order to pay those charges.
And it's key that insurance goes into trust, because if it doesn't, it comes back in your name, and therefore it's
all falls away. Yeah, not a great thing. I think at that point we will thank everybody for attending, and we'll close this down. Thank you again. For those people, if you've joined late, there will be a recording of this made available at a later date. I think probably a couple of days, and you'll be able to get access to it. I think via your partner or via the invite link that you got originally. So thank you very much, and we'll see you again soon.
Thanks, everyone. Bye.